In a previous video, I explained how my mortgage pension strategy may pay off your mortgage years earlier without having to make additional principal payments or having to cut unnecessary expenses and redirect those payments toward your mortgage. In this video, I'm going to explain how an accelerated paydown strategy may further reduce the time required to pay off your mortgage. And in addition, I will explain how to create a tax-free pension. Before I continue, I want to make it clear that I live in Canada and the products I use are available in Canada. I'm sure that identical products are available in other countries as well, but you may need to do a little research before you implement the mortgage pension strategy. Well, let's look at a typical family. Home value $700,000, mortgage $300,000. They have a payment of a monthly of $1,400. Credit card debt of $15,000 with a monthly payment of $450. A vehicle loan of $7,000 with a monthly payment of $400. So their total monthly payments come to $2,250. In this accelerated strategy, let's refinance the house for $400,000 instead of $322,000 as in a previous video. So you're now combining the total debt into an interest-only mortgage. So the debt has now increased to $400,000. I know it seems counterproductive to increase the total debt in order to pay off the mortgage sooner, but bear with me as I demonstrate how effective this strategy actually is. By increasing the mortgage to $400,000, you combine your total debt of $322,000 and have an additional $78,000 to invest into your TFSA. So the total current payment is still $2,250. The interest on the mortgage now is $1,000. So you're going to invest the difference into a TFSA of $1,250. The TFSA is an account that compounds tax-free. So the current deposits start off now at $78,000. Your monthly deposit is $1,250. The annual return is 9%. And again, it's compounding interest. So it's going to compound on a monthly basis. And the current maximum amount into TFA is actually $6,000 annually, but we're going to assume the couple is maxing out at $12,000, plus they're going to use previous unused room in their TFSA. So in year one, you've now grown to $100,951. By year four, you're up to $183,550. By year six, $252,338. By year 8, you're up to $334,636. By year 9.5, you're at $406,804. So you actually can pay your mortgage off 15.5 years earlier without changing your current payment structure. My strategy is called the Mortgage Pension Strategy, and so far we've only talked about the mortgage part of the strategy. How to pay off your mortgage years earlier without incurring any additional principal payments or cutting unnecessary expenses. Now, I'd like to introduce the pension part of the strategy. So let's return to the original example of paying off your mortgage in 11 years. So you would then reduce your monthly mortgage expenses by $800. Well, do not stop investing the $1,450 into your TFSA. You have reached your first goal. Now let's turn your attention to creating a tax-free pension plan. The original mortgage term with the bank was for 25 years, so let's use this date as a benchmark. So year 11, pay off your mortgage. Years 12 to 25, continue investing $1,450 monthly. By year 15, you're $83,405. By year 25, you're $485,000. If you draw out 6% annually, you may have a tax-free monthly pension of $2,425. And if you choose to not pay off your mortgage at 11 years and continue to make both mortgage interest and investment payments, you'll have accumulated about $1.6 million at the end of 25 years. At that point, pay off your mortgage balance of $322,000 and you're left with $1.3 million. And if you draw out 6% annually, you may have a tax-free monthly pension of $6,500. So in our accelerated paydown strategy, the following scenario may be achieved. If you choose to not pay off the mortgage at year 9.5 and continue to make both mortgage interest and investment payments, you may have accumulated $2.1 million at the end of 25 years. At that point, pay off your mortgage balance of $400,000 and be left with $1.7 million. If you draw out 6% annually, you may have a tax-free pension of $8,700. Do you understand how the strategy works? You're not paying any additional funds toward the mortgage principal or cutting back on any current expenses. The mortgage principal does not reduce like a traditional mortgage. Rather, the principal payment is directed to your compounding tax-free investment account. Effectively, you're borrowing at 3% simple interest and earning 9% compound interest. For most people using my strategy, the investment account may in time equal the outstanding mortgage principal, and at that point, they can choose to pay off the mortgage in full. Whether or not they choose to do so, they need to continue paying into the investment account to create a tax-free pension plan. Check out some of my other videos, and if you found this video beneficial, please consider subscribing to my channel and hit the like button. Thank you for watching.